So most people who are overpaying their mortgages are probably doing it wrong. Not because overpaying is a bad idea. Look, in the right circumstances, it is probably one of the best financial moves you can make. But there is a very, very specific number, a specific threshold where the bank quietly stops rewarding you for your discipline, and almost no one talks about it. Look, past that point, you're still obviously paying down debt, right? You're still being responsible. You just might be volunteering to pay thousands more in tax than you need to for a return that's a fraction of what you could be getting elsewhere. So by the end of this video, you want to know exactly where that point in the line is, where the tax system makes overpaying far more expensive than most people actually realize, and what to do with the money instead. Because we're going to run a proper three-way comparison: pension versus ISA versus mortgage overpayments. Not some vague "it depends" answers, actual maths based on where you sit. So let's get into it. Before we do that, I've actually built an app that walks you through this entire decision so that you can put your own circumstances in. It's based on your own numbers, your own loan to value, your own tax bracket, all of it. I'm going to show you how it works towards the back end of the video. But if you want to get ahead of that, the download link is in the description below right now, so you can download it and use it as we go. So to understand where the line is, you first need to understand how your mortgage rate is actually set, because I see most people think that it's just kind of about your credit score or your lender's mood on the day, and that is just not the full picture at all. The number that your lender actually cares about is your loan to value, your LTV. It's simply how much you owe as a percentage of what your home is worth. So borrow £180,000 on a £200,000 property, that is a 90% loan to value. So if you owe £120,000 on the same property, you're at 60% loan to value. The reason this matters is incredibly simple. The lower your loan to value, the less risk the bank or the lender is taking on. If you default, they can easily recover their money. So as your loan to value drops, they reward you with cheaper rates. But here's the thing that most people don't realize. The rates don't just slide smoothly over time. They drop off these very, very clear cliff edges. There's specific thresholds where the pricing genuinely changes significantly. So 90, 85, 80, 75, and then 60. They're the big ones. Cross one of those lines and you can unlock an actually genuinely meaningful better interest rate, not by some tiny rounding error, sometimes by 0.5% or more, as you can see. And that rate applies to your whole remaining balance, not just that bit that you've overpaid. So think about what that actually means. So if you overpay enough to cross from, say, 80% to 75% loan to value, your rate drops significantly. That cheaper rate now applies to every single pound that you still owe. That's a turbocharge that most people just don't account for when it comes into this repayment versus investing debate. The zone where this is most effective and is most powerful is above 75% loan to value. That's where aggressively overpaying mathematically sort of pays off. You're buying yourself not only the guaranteed return of paying off the interest, but you're chipping away, getting closer to a cheaper rate on a bigger balance. And you're doing it with that certainty, as you say, of that guaranteed risk-free return. That's kind of something that potentially no stock market investment can actually promise you. But at 60% loan to value, the bands kind of stop. There is no 55% band, no 50% band. The lender is already giving you kind of their best pricing, and no amount of further overpaying changes that. Look, you're still reducing your debt past this point. You're still earning a return equal to your mortgage interest rate, but you've lost that multiplier effect. You're not unlocking, you're not moving forward to unlocking anything new. So 60%, that is the line. 60% LTV is where the bank stops rewarding you for your discipline. Now, here's the thing. So that's the answer to the question, right? 60%. But here's where it gets genuinely interesting. Because even if the rate bands weren't a factor. The tax system has been quietly making overpayments way more expensive than most people ever actually stop to think about, and actually means the whole notion of overpaying could well be one that you should just not even consider in the first place. Here's the thing. Your mortgage payments, your mortgage overpayments, come from your net pay after tax, after national insurance. Now, that sounds obvious when I say it out loud, but the implications of that are absolutely significant. And most people just don't factor it in and don't walk through the maths of what that actually means. So let me sort of take you through an example and make this concrete. Say you want to overpay £500 a month on your mortgage. Simple enough, many people do it. But to actually have £500 sitting in your account to overpay the mortgage, you had to earn it first. You've got to earn that £500. And the tax man has already taken his cut before it gets to you. Look, if you are a basic rate taxpayer, so that's someone paying 20% income tax, less than about £50,000 a year, you would need to earn roughly £620 to end up with roughly £500 to put towards the mortgage. So you can see the gap, the friction has started to open up there. The friction is real, but it's manageable, right? That doesn't really change the entire circumstance. But if you're a higher rate taxpayer at 40%, you need to earn closer to £835 to make that same £500 appear in your bank account so you can overpay. You're basically handing £500 to the bank, but the actual cost to you in gross earnings, the amount of money that you've actually physically had to earn, of nearly £170 more than a basic rate taxpayer. And it gets even worse. If you're caught in that horrendous 100k tax trap, where your income and your personal allowance is being clawed back, leaving you with an effective marginal rate of 60%, it costs you roughly £1,250 in gross earnings. £1,250. Think about that. Just to put £500 towards your mortgage. You're paying £750 to the government for the privilege of giving the bank £500 every single month. Now, look, I've noticed a bit of a pattern talking to people about this. The ones who are, I would say, like most proud of their overpayments, the ones who've been really disciplined, really consistent, they're often the people who are in these higher rate tax brackets. And without realizing it, they are paying the most in tax to make those overpayments happen. It is brutal. Look, that's not a criticism. The instinct to clear debt is unbelievably healthy, but the maths matters. It's so important. Here's the contrast. Pension contributions come from your gross pay. The tax relief does the heavy lifting before your money even moves. So a higher rate taxpayer putting £500 into a pension doesn't need to earn £835 to sort of fund it. The relief reduces the net cost to them dramatically. Effectively, it only costs them £300 out of their take-home pay to get £500 in a pension. Now, just think about that gap for a second. So you're £300 out of pocket for £500 into your pension versus £835 out of pocket for a £500 payment towards the mortgage. The maths isn't about being clever or finding loopholes. It's about not volunteering to pay more tax than the actual law requires you to do. And this is where we bring all of these three options together, because the right answer genuinely depends on where you sit on multiple different factors. Now, I want to frame this properly. This isn't a lecture telling you what to do. Each of these three options has a real place depending on two specific things: your loan to value and your tax bracket. So if you get those two inputs right, the answer tends to become fairly clear and should help you guide those decisions. Option number one, keep overpaying. This is the right move, generally speaking, when both of the following are true. You're above 75% loan to value, meaning that you're still in the zone where crossing that rate band has a real multiplier effect on your whole balance. Second, if you're generally a lower tax banded taxpayer, so a basic rate taxpayer, meaning that the tax friction cost between what you earn and what you get is relatively manageable. When both of those conditions are kind of met, overpaying is kind of hard to beat, right? You're getting a guaranteed risk-free return equal to your mortgage rate. You're buying yourself a better rate on the entire remaining mortgage balance as you chip away and cross the relative bands. And there is absolutely nothing wrong with also the psychological benefit either. Some people just genuinely sleep better at night with less debt hanging over them. And that is, in my view, a legitimate reason to prioritize it. But it works best here, where the feeling and the maths are pointing kind of in the same direction. Option 2, you could invest and look to put something in your ISA. Now, an ISA doesn't give you tax relief going in. The contributions still come from net pay, just like a mortgage overpayment does. But growth is completely tax-free, and so are the withdrawals. It's flexible in a way that a pension isn't. So you can access it whenever you need it with no restrictions. Now, this tends to work well as a parallel strategy, as it were, once you've hit that 60% loan to value. And certainly once you've cleared that 75% hurdle. You're no longer unlocking new rate bands at that 60% level. And the mortgage overpayment has kind of lost its multiplier effect. And plus, of course, an ISA lets you build a tax-efficient pot that stays accessible for medium to long-term goals. Not the tax-efficient supercharge of a pension that we're about to go through, but flexibility has genuine value. So if you've chipped away and you're certainly below that 75% and you're flirting with that 60% banding, this might be the best option. Of course, again, you've got the conversation point around investment returns of a stocks and shares ISA versus the guaranteed return of your overpayment of your mortgage. Option 3, this is the biggie. For most people who are above the basic rate of tax, so if you're earning £50,000 or more, this is where the maths is genuinely hardest to argue with and almost makes your interest rate on your mortgage totally redundant, because tax relief is everything here. You are immediately ahead before a single penny is even invested or put anywhere else. The higher rate of taxpayer only needs around £300 net out of their pocket to get £500 into their pension. That is a 67% instant return before the money has done anything at all. The long game here is also super, super compelling. So the strategy here might be, because obviously you've got to repay your mortgage at a certain point, you grow that pot, the pension pot, over time. At retirement, 25% of your pension can be taken as a tax-free lump sum known as a PCLS, pension commencement lump sum. And that lump sum, you can use it to clear whatever's left on that mortgage. Now, I recently worked through this exact scenario with a client who was genuinely quite torn between all these options. They've been overpaying for like 2 years or 3 years and feeling really good about it. When we actually put the numbers side to side, they could see that their pension contributions were effectively being subsidized by HMRC, right? While their overpayments to their mortgage were being taxed on the way in. They're still contributing to both, but the balance shifted slightly when they started to uncover essentially the good parts of the pension contribution. Now, one important caveat, right? This only works if you're actually disciplined enough to use the tax-free lump sum for the mortgage when the right time comes. If that money quietly becomes a new kitchen or a new car, the whole strategy falls apart. You have to be honest with yourself about that one, okay? So just think about what is right for you. And for someone earning near £100,000, the pension case gets even stronger because contributions can claw back your personal allowance. The effective rate of relief that in that band can reach 60%. So every £1,000 you contribute towards a pension costs you as little as £400 out of your pocket. At that point, overpaying a mortgage with net income isn't just suboptimal, it's an incredibly expensive habit. So I mentioned that I had an app that would guide you through all of this as a bit of a decision matrix. It's available for free in the link below. So head down there and grab yourself a copy so you can start to understand this for yourself today. I'll show a screenshot so you can see roughly kind of how it all works. But generally speaking, here is a summary. And I wanted to make it kind of as clean as humanly possible. Overpaying aggressively when you're above 75% loan to value and on a lower rate tax band. You are in the rate band zone effectively, so where you can make the most difference. The return is guaranteed, obviously, by making overpayments, and the tax friction costs is pretty manageable. Now, reassess at 60% loan to value. The bank definitely stops rewarding you at that point. The guaranteed return argument kind of still holds, but this is the moment to run your comparison properly on your situation. If you're above the basic rate tax band, pension contributions almost certainly work harder than overpayments, because tax relief means that you're getting more in for less cost before the money has done anything. The mortgage can still be cleared in retirement or later in life with a tax-free lump sum. The ISA sits in the middle, right? Flexible, tax efficient on growth and withdrawals, and useful once you cross that 60% threshold. You want to take a bit more risk with investing, and you want the liquidity over a pension, okay? The number is 60% LTV. That is where the conversation changes. Now, seeing as we're in the topic of pensions, there is an absolutely critical part of that I think is almost critical and criminal that most people do not know about. One of the most important parts of building a big pension pot is, yes, how much you contribute, but also how much your pension, also how your pension is invested. And most people are leaving their pension in what's called the default fund. Now, that is a huge mistake, which is why you really need to watch this video here next, because I'll tell you all about that problem and the things that you might be able to do to fix it in some simple and easy to understand ways. So give it a click and I will see you there.